Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. The world of investing is often dominated by the abstract, stock tickers flashing across a screen, complex derivatives, digital currencies that exist only as code. Yet one of the oldest and most tangible assets remains one of the most compelling. When asked about his vast land holdings, Ted Turner famously quoted Gone with the Wind, saying, "It's the only thing that lasts." That sentiment captures the essence of today's topic, farmland. This isn't a conversation about quaint family farms, but about a formidable asset class valued at more than $3.5 trillion in the U.S. alone. My point of view is this. For generations, farmland has been a quiet builder of wealth. And in today's uncertain market, it may be one of the most important portfolio diversifiers for the coming decades. This is a perfect deep dive for the research phase of our Prime framework, exploring a bedrock asset that builds resilient, lasting wealth. Over the next 2 episodes, we'll deconstruct the why and the how of farmland investing. Let's get into it. To understand the appeal of farmland, you have to look past the soil and into the numbers. The data reveals an asset class with strong, consistent performance and remarkably low risk compared to traditional financial assets. From 1992 to 2024, U.S. farmland has delivered an average annual return of over 10%. That performance isn't an anomaly. Returns have been positive every single year since 1990. Think about that. During the dot-com bust in the 2008 financial crisis, when the S&P 500 was in turmoil, farmland proved its resilience, maintaining its value and continuing to generate income. But returns are only half the story. The real power is in the risk you take to get those returns. Farmland has historically shown significantly lower volatility than public stocks. This combination of strong returns and low risk results in a superior risk-adjusted return. It has been a more efficient vehicle for wealth creation. It moves the conversation beyond just how much did it make to the more sophisticated question, how much did it make for the amount of risk I took? That robust performance is the result of a dual return structure, 2 reliable engines of profit that operate on different but complementary principles. The first engine is capital appreciation, the long-term growth in the value of the land itself. This is driven by a simple yet powerful economic principle, increasing demand meeting a finite supply. On the demand side, global population is projected to exceed 10 billion by 2050, requiring a massive 70% increase in food production. This inexorable rise in the need for food directly translates into demand for the land that produces it. On the supply side, the amount of arable land per person is steadily declining due to urbanization and development. This fundamental imbalance provides a powerful long-term tailwind for farmland values. The second engine is current income, which provides a consistent cash flow. Unlike a hard asset like gold, farmland is a productive asset. The primary source of this income is cash rent paid by farmers who lease the land. This typically produces a cash yield of between 4% and 8% annually. But you can also generate ancillary income from things like hunting leases, billboard rentals, timber sales, or even leases for solar panels or windmills. It's the existence of these 2 distinct return streams that makes farmland such a powerful diversifier. Its value is tied to the inelastic demand for food, not corporate earnings or investor sentiment. In an era of market volatility, investors are constantly searching for assets that can provide stability. Farmland serves as a premier defensive asset. First, it's a diversification powerhouse. Data consistently shows that farmland returns have a very low correlation with traditional assets like stocks and bonds. A study from Farm Together found a correlation coefficient of just 0.01 between private farmland and U.S. stocks. A coefficient near 0 means there's virtually no statistical relationship. This low correlation acts as a ballast during market storms, with positive returns from farmland helping to offset potential losses elsewhere. Second, it's the definitive inflation hedge. This is one of its most powerful characteristics. During periods of rising inflation, the prices of agricultural commodities, corn, soybeans, wheat, also tend to increase. Higher commodity prices mean higher revenues for farmers who can then pay higher cash rents. This direct link means the cash flow generated by farmland tends to rise in lockstep with inflation, protecting your real return. While gold is also seen as an inflation hedge, farmland has a critical advantage. It's a productive asset that generates cash flow. Gold is not. For decades, the standard 60-40 stock and bond portfolio worked because the two were negatively correlated. In recent years, that relationship has broken down. Farmland offers a compelling solution, acting as a strategic replacement for the stabilizing role that bonds have traditionally played. Now, that all sounds fantastic, but a comprehensive analysis requires a balanced look at the challenges. Direct investment in farmland is a complex undertaking. Let's start with the pros, what I call the bull case. First, it's a tangible and enduring asset. You can walk on it, see it, and touch it. It has intrinsic value and will not decline to zero, providing a financial backstop that is rare. Second, it's a vehicle for legacy and generational wealth. Farmland is a durable asset that can be passed down from one generation to the next. And third, direct ownership can offer significant tax advantages, including deductions for operating expenses and the potential to defer capital gains through a 1031 exchange. Now for the cons, let's call these the bear case. The biggest one is illiquidity. You cannot sell a farm in an afternoon. This is a long-term hold, and your capital will be tied up for years. Next is the high barrier to entry. Acquiring a productive farm requires substantial capital, often running into the millions of dollars. It is also management intensive. Owning a farm is like running a business. Even if you lease the land, you need to oversee the lease, monitor the health of the land, and make strategic decisions. And finally, there are unpredictable drivers. Your returns can be significantly impacted by adverse weather, volatile commodity prices, and pests or diseases. It is precisely these challenges of direct ownership that have given rise to modern, more passive ways to invest, which we'll cover in our next episode. The evidence today paints a clear picture. Farmland is a historically high-performing defensive asset class driven by the non-negotiable long-term demand for food. Its value is underpinned by powerful megatrends in demographics, climate adaptation, and technology. The powerful why behind farmland investing has been established. But for an investor, the critical question remains, how do you act on this information? Next week will serve as your investor's playbook. We will explore everything from the complexities of buying a farm directly to the nuances of investing in publicly traded REITs and the emerging world of equity crowdfunding platforms. And most importantly, we will reveal the top 10 costliest mistakes that can turn a dream investment into a financial nightmare. Thanks for tuning in. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one smart move at a time.